Hi guys, welcome back to Father and Son Investing. We're going to continue a topic that I hinted at the end of my last video. In 1994, James Carville, who at the time was a political advisor to President Clinton, remarked, "I used to think that if there was reincarnation, I wanted to come back as the president or the pope or as a 400 baseball hitter. But now I would like to come back as the bond market. You can intimidate everybody." Today's video is going to be talking about bond vigilantes. What are they and what can they do to the bond market? Should we expect them to be doing anything anytime soon? So let's get started. First, let's just understand what bond vigilantes are. They're not actually vigilantes. They are large groups of investors. We're talking about large institutions, banks, insurance companies, money market funds, etc. They can also include foreign investors such as foreign governments. Essentially, when these large groups of investors get together and decide that they don't like what the U.S. government is doing in terms of either monetary policy or fiscal policy, they start to sell off their bonds. We saw a brief example of this back in the fall in October when bond yields started to rise because prices were falling so quickly. Let me give you another example of just how quickly bond vigilantes can affect bond market yields. Let's illustrate this by using Liz Truss as an example. She was briefly the Prime Minister of the UK. You may be thinking, I don't remember Liz Truss as the Prime Minister of the UK, and that's because her tenure was extremely brief, only lasting about 6 weeks. She took over on September 6, 2022, and quickly announced some budget proposals that threw the UK bond market into a tizzy. One of the proposals was to freeze the cost of energy within the UK. Essentially, the government would borrow money to freeze the cost of energy prices for the citizens of the UK. That, combined with a proposed tax cut for the wealthy and for corporations in the UK, sent the bond market prices spiraling downward and yields spiraling upward. Just take a peek at how quickly these bond yields went up here in blue after this announcement. Also take a peek at how the pound compared to the dollar just plummeted after that announcement. Well, it wasn't too long that Liz Truss was essentially removed from that post as Prime Minister through another election in the UK. This is an example of what bond vigilantes can do when they don't like the policies that the government or the central banks are proposing. Now, if you're not aware of it, there was a time within the United States when bond vigilantes did a similar thing for a prolonged period of time. During the 1970s and 80s, when inflation was running rampant and bond yields were not keeping up with that, the bond vigilantes took over about 1983, where they started selling off their bonds, and you can see here how the bond yields started to rise. That persisted out into the Clinton era, and thus that's when James Carville was talking about wanting to come back as the bond market because it wielded so much power. Eventually, during the Clinton administration, the government actually balanced their budget and for a time period had a surplus. All of that was brought about in part due to bond investors not liking the fiscal and monetary policy of the United States. Now, in my mind, the biggest reason why bond vigilantes may rise up again has to do with this, the 27 trillion Treasury market, and the fact that it's only getting bigger. This graph here breaks down that $27 trillion U.S. Treasury market. You can see it based on bonds, notes, and bills, as well as other forms of U.S. Treasury debt. Just how much has that Treasury market grown recently? Well, according to the Wall Street Journal, the Treasury market has grown more than 60% to $27 trillion since the end of 2019, and it is roughly six-fold larger than before the 2008-2009 financial crisis. These graphs here give you an idea of who the potential bond vigilantes could be. One of the things I want you to see here are money market funds. Look at how the money market fund purchase of U.S. Treasuries just exploded at the onset of COVID, rapidly decreased, and now has come back to significantly high rates, as high here as what is labeled here as households. You need to know that included in households is hedge funds. So a lot of this is not you and I buying U.S. Treasuries, but hedge funds buying U.S. Treasuries. There's a problem, though, with hedge funds and U.S. Treasuries. And here's the problem when it comes to hedge funds. You may be aware that the Fed, the central bank in the U.S., has been decreasing its holdings or letting U.S. Treasuries run off its balance sheet. They're not purchasing more. Well, the hedge funds have stepped in and have been accumulating U.S. Treasuries, and that has really kind of propped up the economy when it comes to U.S. Treasuries. But here's one important problem. Hedge funds like to get in on Treasuries and Treasuries futures, and there are some new rules being proposed by the SEC that could reduce the profitability of that Treasury futures trade, and thus hedge funds, which are currently suing the SEC, are already starting to pull back in terms of their purchase of U.S. Treasuries. Not only that, but foreign governments have been pulling back on their purchases of U.S. Treasuries. Take a look here at the foreign holdings as a percentage of U.S. debt. You'll notice that it has dipped now well below the 30% range. We're down in the range of about 25% of the total U.S. debt being held by foreign entities. Now, all of that combined with the possibility of bond investors just deciding that they're going to sell off their bonds and not purchase more at the current yields can rapidly increase the Treasury yields here in the United States. Now, you may be thinking that something like this just wouldn't happen in the U.S. bond market, but let's just take a peek at what happened recently in the U.S. stock market when it came to a group of investors deciding that they were going to make a change. You'll recall these meme stocks where people decided that they would not be willing to sell stocks that were being heavily shorted. And because they weren't willing to sell them, the prices on these stocks started going up as those who were shorting the stocks had to repurchase the stocks. Of course, as these prices skyrocketed, those short sellers ended up paying outrageous sums of money in order to buy the stocks that they needed to return that they were borrowing. And so we saw things like GameStop going up 1,000%. We saw AMC going up almost 2,700%. Craziness here, and this can happen in the bond market. Now, not to this extent. I don't think we're going to see yields go all the way up to 18% like they were back in the early 1980s. But just get an idea that 4.3% that we have today could quickly go up to 6% within the next few months, simply by some of the things that I've been discussing here, combined with bond vigilantes. In fact, just today there was a large spike in the yields on the 10-year note and multiple other treasuries. You'll see the 7-year with a large spike, the 5-year with a large spike up, and the 3-year with a large spike up. The 2-year also took a big jump up in the yields. And why did this happen? This was simply because of some more economic data that came out today, and the result that people started to sell off their U.S. Treasuries, and thus the yields went up. So this can happen quite quickly. I hope you learned something today about bond vigilantes. If you did, please give us a thumbs up. We'd love to have you as a subscriber. And until next time, enjoy your investing.